Evening, y'all. Evening, everybody. We're going to go ahead and get started for tonight. How's everybody doing out there? I'll fire up the chat room here, make it lively, because I know none of us are excited to be in class on a Monday night after a long day back after a beautiful weekend. So let's have some fun in the chat room tonight. And hopefully everybody did something fun this weekend, because the weather was too dang beautiful to keep yourself locked up inside for sure. So tonight we're going to go ahead and we're going to start off by reviewing the Sunset Boards mini case. Thanks to everyone who got their Excel file submitted. I appreciate that. I'll be reviewing everybody's case individually. But let's go ahead and just kind of review what the case was all about, and kind of just recapping the chapter 2 as it relates to the building of the financial statements. So Sunset Boards, they gave you a bunch of information, and it wasn't in any particular order, just kind of thrown at you, and you had to figure out what was an income statement item, what was a balance sheet item. When we get to the midterm, that's pretty much how it's going to look. All right. I'm not going to tell you what's an income statement item, what's a balance sheet item. I'm just going to throw a bunch of information at you, just like this particular mini case did. And then you're going to have to parse out which line item goes to which financial statement. So if we build the two income statements for Sunset Boards, in 2017, you should have had a net income of 85,101. And you should have had a net income of 97,433. Okay. The dividends of 34,040 and 38,973. And as we talked about, what would have flowed to retained earnings on the balance sheet for both of those years is just the difference between net income and dividends. So net income minus dividends, okay, gives you the addition to retained earnings for both of those years. And then the case gave you a little curveball, right? It didn't tell you a single thing about retained earnings on the balance sheet for 2017. All it told you was they had new equity. And in 2017, it was zero. And in 2018, it was $19,500. So when we went to build the balance sheet, again, we plugged in all of the information that we were provided. The assets came up with 431,683 for 2017, 545,155 for 2018. Plugged in the accounts payable, notes payable for both years, long-term debt for both years. And then we got to equity. And we had to give some thought to what we talked about as it relates to both sides of the balance sheet having to balance out. And since we didn't get any information related to equity in totality for 2017, and the only piece of information that we were given as it relates to new equity in 2017 was that there was none, okay? We essentially had to use retained earnings in 2017 as the plug, okay? So without anything being given to you, we were off by 216,587, okay? Or the total liabilities and equity was 216,587, which created an imbalance of 215,096. So we simply needed to make a choice, and we plugged that number into retained earnings, okay? You could have plugged it into common stock. The math would have worked out fine, okay? But since you were given equity as 0 in 2017, most of you plugged retained earnings as that number 215,096, okay? Which then created and forced the 2017 numbers on the balance sheet to balance out, okay? And then we moved to 2018, okay? And most of you picked up on the math, how the money flows from the income statement to the balance sheet. And you said, okay, in 2018, I know that I start 2018 with the retained earnings that I ended 2017 at. And we know we ended 2017 at 215,096 because we forced it to be that number, right? And during 2018, we had operational activity from our income statement, okay, that led to $97,433 of net income, which is great. And we know that we paid dividends to shareholders in the amount of $38,973, which means that whatever was left over had to flow to retained earnings. And what was left over was $58,460. Okay, or the difference between net income and dividends, same thing. And so when we looked at the calculation for the new retained earnings number for 2018, all we did was say, we took what we did in 2017 and we added to it what we kept for ourselves in the form of retained earnings. The difference between net income and dividends. That's what we kept for ourselves. The plowback number, how much we plowed back into our business. And that was retained earnings. And now you'll see we're still out of balance. The assets of 2018 do not equal the total liabilities and equity for 2018. Well, what's the difference on that? And lo and behold, the difference is $19,500. which is exactly the new equity that was issued into the market from Sunset Boards. So common stock goes from 0 in 2017 to 19,500 because that's new equity, and bingo, bango, bongo, we're balanced. Okay? So there's your income statement. There's your balance sheet for Sunset Boards. Then the questions continued. What's the operating cash flow for 2017? Operating cash flow is nothing more than EBITDA less taxes. So EBITDA 195,568 minus your taxes 22,622 gives you OCF of 172,946. So that's how much operating cash flow, like real cash, all right, that the firm generated in 2017. Same math applies for 2018, EBITDA minus taxes, 196,972. Okay, so they generated more free cash in 2018 than they did in 2017. And then we got into how do we go about calculating the cash flow from assets using the operating cash flow method versus the cash flow to shareholders, cash flow to creditors method. So first question, calculate CFFA for 2018 using the operating cash flow method. Well, CFFA using the operating cash flow method is operating cash flow minus net capital spend minus the change in net working capital. So I would encourage you, and this is just a suggestion, you don't have to do it. If you feel like your Excel skills are freaking awesome and you never make mistakes, you don't have to do it this way. Personally, I find that if I try to do one massive formula in one cell, I always wind up making a mistake. So I generally break it down into the components. So here I've calculated operating cash flow, okay, for 2018, which we'd already done. I've calculated net capital spend, which is the change in net fixed assets year over year, adding back depreciation. Don't forget to add back that non-cash item, okay? So 387,855 minus 318,345, adding back depreciation for 2018 gives us net capital spend of 151,069. And then we look at the change in net working capital. And if you remember from last week, net working capital is the difference between current assets and current liabilities in any given year. So the change in net working capital is the net working capital for 2018, current assets minus current liabilities, minus the net working capital for 2017. 2017 current assets minus 2017 current liabilities. All right, and we talked about if you're going to make a mistake, this would be the place that you're going to make it, simply because you're taking the difference and another difference. Right? So change in net working capital was 23,101, meaning that year over year, the increase in sales that we saw, okay, because we moved from 501 to 611, so almost a 20% increase in sales, okay? That additional increase in sales caused our net working capital year over year to go up. We needed more money to run our business every day, which makes sense. If our sales go up, our cash should go up. If our sales go up, we should see a change in AR. If our sales go up, we should see a change in inventory. If our sales go up, the materials that we have to purchase in order to produce the products that we sell, AKA accounts payable, bills that we owe to our suppliers, should also go up, okay? So our sales increased and we saw an increase across the board. So the money that was required to run our business on a day-to-day basis, the change in net working capital increased year over year. And when we take operating cash flow minus net cap spend, minus the change in net working capital, our assets delivered a positive $22,802 to the business, okay? Which is obviously a good thing. So that was method number one. And then method number two was, let's use this cash flow identity, all right, and translate the cash flow from assets that we derived using the OCF method. And let's look at cash flow from assets as it particularly pertains to our creditors and our shareholders. So how it pertains to the cash that was delivered based upon our debt to equity leverage decisions that we're making as financial managers. So the first thing I'm going to do is calculate our cash flow to creditors. All right, what is cash flow to creditors? Cash flow to creditors is the interest that we paid on the debt service that we have, so 17,980, minus the change in our long-term debt. Did we pay down debt? Did we take on more debt? In this case, we took on more debt. $15,000 and change of additional debt was taken on year over year. So our cash flow to the creditors turned out to be $3,329, right? Cash flow to shareholders. How much did we pay out in dividends directly to our shareholders, minus how much new equity did we issue into the market? We paid out $38,973. We issued $19,500 of new equity. Therefore, our cash flow to shareholders was $19,473. Add those two things together and we get $22,802, the exact same number that we got when we used the operating cash flow method. Cash flow identity holds and your check is zero, right? So for those of you that are currently in finance, FP&A or accounting, I hope you build in checks to your files, right? Because I am sure that many of your Excel files are drastically larger than what we're dealing with now. But if you're not building in these kind of checks to make sure that the cash flow identity holds, you need to be building in checks, just so you can easily tell where the balances need to occur and if there's an error somewhere. Okay, so I'll post this Excel file up on our Moodle page this evening so that everyone can have an opportunity to see, you know, how it got built out. But I would say for the most part, everyone did a really great job on the mini case. And this kind of case right here, this is exactly what you're going to see on the midterm. Okay, so if you start building out your Excel file right now to show your income statement pretty much as it exists right here and your balance sheet as it exists right here, you're really going to put yourself in a much better position from a time standpoint. Okay. All right, I can't see the chat room, so no, everybody's quiet tonight. Okay. All right. So if there's any questions about that, feel free to reach out to me. If you didn't understand something about how we built the retained earnings and the common stock and how we plugged retained earnings in 2017, reach out and we can talk offline one-on-one, about that. But for the most part, everybody did a great job piecing that together. Okay. So tonight we're going to get into how we go about working with these various financial statements. Okay. And in particular, we're going to start talking about ratio analysis. We're going to look at something called the DuPont identity. We're going to look at how we go about standardizing financial statements, which is a really, really important thing. Okay. Drew, what is one of Stanley Black & Decker's competitors that's publicly traded?
TTI, Milwaukee.
GTI?
Actually, I don't know if they're publicly traded.
Or just, it doesn't matter if they're publicly traded. It was just, what's
GTI.
GTI? Okay, so Stanley Black & Decker, they have financial statements. What's the revenue? How much revenue does Stanley Black & Decker make in a given year?
16 billion.
16 billion. Okay, so Stanley Black & Decker makes $16 billion. Big, big number, right? The competitor, GTI, don't know if they're publicly traded. Let's just say that they're not. We don't have access to their financials. Maybe they're only a $10 billion company compared to $16 billion with Stanley Black & Decker. And what we want to do is we want to try and find out how we can compare these two companies to one another to see who's operating more efficiently. Well, looking at the raw numbers doesn't do us any good because one is significantly larger than the other. Okay, so what we have to do is we create these standardized financial statements where we take every line item, all right, on the income statement, and we look at it as a percentage of total sales or total revenue. So we convert each dollar amount into a percentage amount, which allows us to see from a cost of goods standpoint, what percentage of the total revenue is tied up with the cost of goods? How well are these two companies that engage in the production of power tools, the same industry, how well are they sourcing their materials that go into the products that they eventually sell? Are they pricing their product as a premium or as a discount? So when we convert these financial statements into standardized financial statements, it allows us to compare businesses within the same industry against one another. But if we took this example of Stanley Black & Decker and we said, well, let's compare Stanley Black & Decker to Facebook, it falls apart. They're two totally different industries, two totally different sectors, right? So creating a standardized financial statement for companies that are not in the same industry makes no sense because it doesn't tell you anything. So we'll get into how we go about creating those standard financial statements, all right? Here we go. I am ahead of myself. This thing doesn't work very well. Okay, once we learn how to create those standard financial statements and we can see one company to the next, right, then we're going to get into ratio analysis, right? How well are companies managing their inventory? What is the return on equity, return on assets, profit margin, bottom line over top line, okay? what leverage do companies employ called the equity multiplier, which gets used in what's called the DuPont identity for the calculation of return on equity, which quite frankly is one of the wackiest formulas that I've really ever seen derived by literally an engineer from DuPont who came up with this. And it'll blow your mind when you see it, but it makes perfect sense. And it is absolutely fantastic as a measure on how to go about looking at the three most important parts of any business, right? And then finally, we'll close out with how we go about using the financial statement information, and we'll go through an example within Excel. Right? So on Moodle, I went ahead and put the handouts, all right? So you'll have the handout PDF has got the balance sheet, it's got an income statement, and it's got a cash flow statement for kind of what we're going to run through here for the next 15 or 20 minutes. So when we look at a balance sheet, all right, we know we've got assets on one side and we know we've got liabilities and owner equity on the other side, all right? The question then becomes, when we think about the different line items on the balance sheet, what line items become a source of cash versus a use of cash, right? We talked briefly about this last week, but in the case of this particular entity, we can see that between 2019 and 2020, cash increased, all right, from $58 million to $108 million. Naturally, that's a source of cash. Cash is cash. However, we saw that accounts receivable moved from $992 million to $1,156 million. So when you think about that change in accounts receivable, going from 992 to 1156, is that increase in accounts receivable, is that a source of cash or a use of cash? And anyone can answer, you can use the chat room, you can speak up, but is an increase in accounts receivable, is that a source of cash or a use of cash?
Source of cash.
Okay, I've got a source of cash. Anybody else want to take an opposing view?
So accounts receivable would mean more time for your customers to pay you. So wouldn't that eat up cash?
Thank you very much, Morgan. That is exactly 100% correct. This is a use of cash, all right? Your clients, your customers are taking longer to pay you, okay? You have more money out there to collect, all right? Now, let me take one step back. I said that they're taking longer to pay you. That may not necessarily be the case. It could just mean they're buying more and therefore their balance that they owe to you is growing larger as a result of the increase in sales that you experienced, okay? So it could be that they just have a larger balance with you, or it could also be that they renegotiated their payment terms to pay you in a longer period of time. Regardless, when you see accounts receivable move up, that is a use of cash because that's money that you're waiting to collect. You haven't collected it yet, therefore you can't use it yet. So an increase in accounts receivable is a use of cash, okay? Now, the opposite side of accounts receivable is obviously accounts payable, okay? Meaning money that we owe to our suppliers for the product that we purchased that we then either convert into the product that we sell or in the form of, pencils that we use in the office to take notes during the meetings that we're in, the endless Zoom meetings that we're in. So when we think about it from that direction, accounts payable for this firm went from 303 to 307, so we had an increase in accounts payable. So if we have an increase in accounts payable, would that be a source of cash or a use of cash?
Source?
Source. Drew, why?
Well, I mean, it's the opposite of accounts receivable, I guess, but because you're not using that cash at the given time and you're deferring it out.
Okay, so you are electing to pay your bills later, okay? Or you simply built up a larger balance with your suppliers that is still due at the same period of time, but you are able to keep that cash that you otherwise would have had to pay your suppliers. You're keeping it for yourself to do something else with it. So an increase in accounts payable is a use of cash for the firm, okay? Very good. Inventory. We went from 361 to 501. Source of cash, use of cash.
Use.
Use of cash, right? Because we spent money, we built the products, we built what we're trying to sell, and now it's just sitting on a shelf in a warehouse somewhere waiting to be sold. Okay, so we used our cash to manufacture the inventory, and now that inventory is sitting there on the shelf waiting to be sold. So it's a source of cash. Exactly right. Net fixed assets, obvious. If it goes up, you used your cash. That's a use of cash, right? Notes payable, right? We went from 119 to 26. Source of cash, use of cash. Short-term debt that we owe went from 119 to 26.
Use.
Catherine.
Say source.
Up, notes payable, short-term debt that we owe to the banks went from 119 to 26. Is that a source of cash or use of cash?
I would say source because you have more, I guess, a higher balance with a bank or more time to pay the bank.
Maybe you're going the other direction. So we're going from 119.
Oh, okay.
We're going from 119 to 26. We're paying down.
Oh, sorry. Got it. I did see the wrong direction. Okay, then that is a
That's
use
okay.
of cash. Sorry.
I figured you were going the wrong direction. So yeah, we paid down debt, right? We paid down short-term debt. We went from 119 to 26. Use of cash, we paid down debt. Long-term debt, same thing. We went from 1091 to 843. We paid down long-term debt. Fantastic. All right. So that's a use of cash, right? Common stock, we went from 2167 to 2768. Source or use?
Source.
Source. We got more money, right? Whether it was in the form of new equity issued into the market via new shares, or just we did a damn good job as financial managers and our stock price went up year over year and the value of that common stock changed. We had more sales, we brought more retained earnings into the business, therefore total equity went up. It is a source of cash for the firm, okay? So when you get into the exercise for your assignment for this week, which is twofold, okay? Begin to think about how these changes year over year relate to cash. Okay, because that's the financial manager's decision. We want to know how much cash do we have and how can we best allocate it? And then what cash is going to be required to run the business on a day-to-day basis after we make those first two choices. Okay, so understanding what's a source of cash and what's a use of cash becomes very important as a financial manager. Okay. Income statement. So does anybody have any questions about the balance sheet? All right, in terms of source, use, year over year change. I mean, this is a pretty basic balance sheet, right? If you go look up your company's, financial statements at sec.gov, they will look 100% not like this. They're much more detailed and contain a significant amount more information, but the concepts are the same between this example and the 2 pages of balance sheet information that your companies might produce. Okay, yes, Eric, you're right. We use cash to pay it down. Good job. Okay, income statement. All right, we've got revenues. We back out our cost of goods sold. We have expenses. We have depreciation. That gets us to EBIT. We have some interest expense that we pay to our creditors, which gets us to EBT, aka taxable income. We have taxes that are calculated based upon EBT / taxable income, and we get down to net income of $893 million. Fantastic, great. We did a good job. We've got money left over. Now we're going to get into some other metrics that are pretty meaningful when we start evaluating the performance of individual companies, when we start to compare them against one another within the same sector, the same industry. So for this particular example, this company has 190.9 million shares that are outstanding within the market, shares that are issued into the market for buying and selling. When we take the $893 million of net income, earnings, and we divide that by the 190.9 million shares in the market, we come up with a number, 4.68. That 4.68 is a very important number that we call EPS, or earnings per share. $893 million of earnings divided by 190 million shares gives us an EPS of $4.68 per share. When we get into a conversation around price to earnings ratio, the price to earnings, the earnings component of that ratio is EPS. Okay? When we think about dividend yield, or the yield that we earn on an investment as it relates to the price that we purchased the security at, we look at the dollar amount. We look at the dollar amount per share of dividends that the company pays out. So in the case of Sunset Boards, they paid out a certain number of dollars in the form of a dividend, okay? In the case of this company, if we take the dividends per share of 1.53 and we multiply it by 190.9 million, we can figure out the actual dollar amount that this company paid out in total dollars related to dividend. Now, let's test your knowledge real quick. What's the retained earnings per share that this company plowed into retained earnings?
Difference between earnings per share and dividends per share.
You got it. That's right. Exactly. So net income, remember, net income equals dividends plus the addition to retained earnings. Therefore, if we're just doing everything on a per share basis, earnings per share equals dividends per share plus addition to retained earnings per share. So the addition to retained earnings per share is simply the difference between those two numbers. Okay, very good. Who was that, by the way?
That was Mark.
Mark, nice job, bud. Great job. Okay, so this relationship between net income and dividends in addition to retained earnings, if you're gonna, with one of the top 5 things that you're gonna take away from this semester, that better be one of the top 5 things, is how net income flows to dividends and then moving to the balance sheet in the form of retained earnings. That's one of the top 5 key concepts that you should be learning from this semester. Okay, so we've already gone through this slide, through the example that we did with the balance sheet on what's a source of cash, what's a use of cash, whether it's an increase in the liability or equity account or a decrease in the liability or equity account. If we pay down debt, obviously it's a use of cash. If we issue more common stock, okay, that's an increase of cash, so it's a source of cash. Nonetheless, I encourage you to think about looking at this company that you'll have for your next mini case, S&S Air, and think about year over year, did they make more money? Did they spend more money? Cash in, cash out, and how much? Okay, because that's what that's what it's all about. That's it. It boils down to that. Tell me how much cash I've got to spend on the projects that I want to spend it on, and then how much cash am I going to need to keep those projects running after I decide what I'm going to do. Period. Plain and simple. Right? So we get to the third financial statement. So we've talked about the balance sheet, all right, and we've talked about the income statement, and now we got to talk about the statement of cash flows, all right, which is different. Now we're going to talk about the accounting statement of cash flow, not the financial manager definition of cash flow. We're literally going to talk about the accounting statement of cash flows. All right. And I promise you that if you are an accountant out there right now, I would be glad to hand over this part of the lecture to you as host to teach this, because I'm not an accountant. I'm a finance guy. And I think of cash as real cash, right? But the statement of cash flow that is required to go to the SEC in the form of a GAAP statement is divided into three different sections. Cash that's generated or used as it relates to the operating activity of the firm, the investment activity of the firm, so changes in your fixed assets, what are you investing in your business, and then what decisions are you making regarding how you're financing your business, okay? So changes in debt, changes in your equity accounts, and that also includes dividend payments that you pay out to shareholders, because shareholder equity, owner equity, that's a financing decision. It's one of the big reasons why people IPO, to get the money. They want that money to come into the business, okay, to help finance part of the operations. So let's take a look at the statement of cash flows. So in the example, all right, if you remember, we started at 58. All right, so 2017, we started at 58. And we know that we went from 58 to 108. So the objective of the statement of cash flows is to bridge the gap. How do we get from 58 to 108 using the three different components of the cash flow statement? All right, so we'll start with the operating activity of the firm. Okay. Our income statement is our operating activity. That's what we did over the course of the year. Okay, so our net income was $893 million. Okay, that came directly off of the income statement that we looked at. Okay, we've got to add back depreciation because that's a non-cash item. We've got to add that back in. Okay, we know that an increase in accounts payable, all right, is a source of cash. So accounts payable from the balance sheet went from 303 to 307. So that's an increase in accounts payable of $4 million. Okay. We see that other current assets went from 264 to 403. All right. So an increase in, current liabilities. An increase in other liabilities went from 1353 to 1662. That is a source of cash. Okay. Now we have to look at the use of cashes from our operating activity. Our increase in other current assets went from 264 to 403, which is a change of 139 negative because it's a use of cash. Our AR went from 992 to 1156, so our AR increased by $164 million, use of cash negative. Our inventory went up by $140 million, negative, use of cash. So therefore, our net cash from operations is the sum of everything. And so the net cash flow from our operating activities was $879 million. All right. So that takes care of the things that we did during the course of 2018 as it relates to simply running our business. The second piece, investment activity. did we use cash to invest in our business in the form of new fixed assets? Well, yes, we did. The balance sheet shows that we went from 3358 to 3438 year over year on net fixed assets, which means we spent $196 million of cash on new fixed assets. So it's a negative. And that's the only investment activity that we did. On the financing side, meaning debt and equity, what happened? Well, so again, remember, why does accounts payable, so accounts payable shows up in the liabilities side of the balance sheet, right? But why does accounts payable show up in operating activity and not over here in financing activity if it's on the liabilities side? Okay, why does accounts payable show up over here and not in the financing side? If accounts payable is on the liabilities side of the balance sheet, and that relates to things that we owe to other people, why is accounts payable not here, but sits over on the operating activity side?
Is it because you still have that money to operate with?
Okay, keep going.
And because you have that money to still, I guess, make decisions with, and still cash that you have on hand.
Right. Why does accounts payable even exist anyway? What is the point of accounts payable? What types of things would go into accounts payable?
Like buying things, so suppliers and things like that. So these are kind of tangible things needed to operate your business, not necessarily financing from a bank.
Okay, key word. There you go. You just said it. Things you need to operate your business. Okay, whether that again is a pencil, a ruler, a ream of paper, or solid steel or aluminum billets in order to manufacture whatever product it is that you're trying to go out and sell. The things that you need to operate your business, you have to go out and procure those things, right? Your purchasing department has to go out and buy those things. Those are the things that are needed for you to operate your company. Therefore, accounts payable sits in operating activity on the cash flow statement and not in financing. Okay, this will become very, very important when we talk about varying, okay, the balance sheet as a percentage of sales growth when we get into pro forma analysis next week. Okay, so remember, accounts payable, for all intents and purposes, is tied to sales. The more we sell, the more product we sell, the more that we're going to have sit on accounts payable, right? Makes more sense. We have to buy more product to produce more product. Okay, so that's why accounts payable sits over here in operating activity and not in financing. Financing relates to debt and equity. Okay, so when we see financing activity, if we look at the balance sheet, we can see that notes payable, as Morgan indicated to us, that notes payable went from 119 million to 26 million, right? So we paid down debt. We used cash to pay down debt, short-term debt. We also used cash in the form of $248 million to pay down long-term debt. We went from 1091 to 843. We paid down debt, right? I'm going to come back to this change in common stock here in just a second. We paid down we paid out to shareholders $292 million. Okay. Now, where did that number come from? You have not seen that number, that exact $292 million yet. Where did that number come from? Do you remember? Dividends paid. Right here on the cash flow statement, it says we used $292 million of cash to pay out to shareholders in the form of a dividend.
So wouldn't
How
that be
do
on the income statement, like your net income minus retained earnings?
Okay, back to the income statement, right? We had net income, which we use to calculate earnings per share. And we have dividends per share. There it is right there. $1.53 per share times $190.9 million. There you go, Eric. Good job. 1.53 times 190.9 million shares gives us $292 million of cash dividends that were paid out the door. Okay? Why is there no change in common stock? We got dividends paid. We got net income. Okay, Will, good. There's no new equity issued. Exactly. So that's very, very clear. So where does the addition to retained earnings sit within all of this? Because we know net income has got to be dividends plus addition to retained earnings. So where does that additional income from the addition to retained earnings, where does that sit within all of this? We know we got dividends sitting right here, right? But do we see a line item for addition to retained earnings? It's not there, right?
Isn't it captured in net income?
Thank you very much, Chad. Very well done. It's already captured. You already did it. Okay, so you took the entirety of the net income of $893 million, right? You took all of the net income, right? Which would be the sum of dividends in addition to retained earnings. And then you said, okay, from a cash flow standpoint, I paid out $292 million of cash to my shareholders. Therefore, the retained earnings is already baked in to the operating activity cash flow section of the statement. Okay? So when we go through and we take $879 million of net cash from operations and we subtract out $196 million of net cash from investments and we take out $633 million from our financing activities, we get a net increase in cash of $50 million year over year. And if we started the year at 58 and we add 50 to it, we end the year at 108 million, which happens to be exactly what is listed on the balance sheet for 2020. Okay. So we just took that entire cash flow statement was geared around explaining the difference between 58 and 108. Using all of this information that is here on the balance sheet, as well as the net income and dividends that were paid out on the income statement to get us to the walk, the bridge, the waterfall to the beginning of the year to the end of the year. Speaking of waterfalls, any of you guys that are out there, you guys ever have to do those in Excel, like create that waterfall graph where you've got the starting point and the end point? All you do is like show the different stacks of pluses and minuses, like to walk it out to the beginning to the end of the year. Somebody's got to be doing that if you're in FP&A or accounting.
Yeah, I do those.
Those suck. I hate those. They're like, it took me a very long time to figure out how to use Excel to make that happen. So hopefully you had a nice template to use and didn't have to figure that one out. All right, so that's all we did. We started at $58 million of cash and we went to $108 million in cash. But there was a whole lot of shit that happened between operating and investment and financing within our business that took us from 58 to 108, right? And now we were easily able to show it on the third of our final financial statements that eventually gets submitted to the regulatory agencies. All right. I will tell you right now that the cash flow statement is my least favorite statement of all of the financial statements, but nonetheless, it is important. Any questions about that walk or the three different components: operating, investment, and financing? Okay. So again, I encourage you, go to sec.gov, look up your company, pull up the statement of cash flows, pull up the income statement, pull up the balance sheet, look to see how they report it, and then go set up a meeting with your controller, with your treasurer, with your CFO, and ask them, talk with them about what that stuff means. Okay. If you learn more about how your business is run, it's going to make you a more effective member of the team. All right. So when we talk about standardizing the financial statements, meaning we're trying to compare one company to another company within the same industry, line of business, sector, you know, SIC code, NAICS, whatever you want to call it, right? We look at these financial statements on a standardized basis, right? So when we think about common size balance sheet, we just take everything and we look at it as a percentage of the total assets, right? So we take cash divided by total assets. We take AR divided by total assets, inventory total assets, net fixed assets total assets, right? Accounts payable, notes payable, long-term debt, common stock, retained earnings, all as a percentage of assets, right? When we think about it in terms of the income statement, we look at it as a percentage of sales, okay? So cost of goods divided by sales is a percentage. Salaries divided by revenue is a percentage. R&D expense as a percentage of revenue as a percentage. So it allows us to convert things into percentage form for standardization for comparison purposes. So the second assignment that you're going to have for this next week before we come back on Monday is the Harvard Business Pack related to the data detective simulation. And guess what? All the financial statements for the 8 companies that you're going to have to identify, they're all standardized. So they're all in percentage form. So it doesn't matter if one company is a multi-billion-dollar company compared to a singular, million-dollar company. It doesn't matter. It's on a common size percentage form. Okay. So when you're doing the simulation, right, everything is on a standardized basis, which allows you to compare one company to the other, to the other, to the other for 8 different companies. Right? So everything on the income statement is standardized according to a percentage of sales. And when we get into an example here in a moment, we'll talk a little bit about my more preferred way of doing it as opposed to the way the text conveys it. All right. But we'll talk about using as a percentage of sales as opposed to just simply the sales growth rate. Right? So it makes it easier to compare the financial information. That's it, particularly as the company grows, because it has no bearing whatsoever on the actual dollars. It has a bearing on what percentage of the revenue that's coming in the door is tied to certain expenses that relate to the operational efficiency of the firm. All right. And again, the most important thing here, same industry. Okay, you cannot do, you can do it, but it's meaningless if you try to compare 2 entities that don't operate within the same space. All right, it would be completely useless to do that. Right? So this gets us into ratio analysis. So it allows us to better compare companies as we move through time. Okay, we can keep track of trends. Okay, has a company taken on more debt over a period of time versus another company? Or has another company made better use of their equity over time compared to another competitor within their market space? And make no mistake, ratios are not just used internally for performance management, okay, to determine what your bonuses are. They're used externally by credit rating agencies to determine solvency, liquidity, your overall credit rating, credit health, financial health for your firm, right? So these ratios that we're going to start going through are used by agencies that allow entities to obtain debt within the market potentially at significantly lower interest rates than if they had poor ratios, solvency, liquidity, operational, compared to other entities within the same space. So when we think about the different categories of financial ratios, we're really talking about 5 different categories. We're talking about some short-term solvency, liquidity ratios, long-term solvency, AKA leverage, so debt versus equity ratios, asset management, so inventory turnover, accounts receivable turnover, accounts payable turnover, so how we're managing the assets that we have, profitability ratios like gross margin and profit margin, okay, operational efficiency, and then market value ratios. How is our stock price trading in relation to other companies that operate within the same space? So price to earnings ratio, okay, terminal value, okay, multiple value. We'll talk about that. So when we think about liquidity ratios, and we go back to the example that we've kind of been working on through the handouts, okay, we talk about a current, what's called the current ratio, right, which is simply nothing more than our current assets divided by current liabilities, okay, meaning do we have enough assets currently, meaning within the next 12 months that we expect to be able to convert to cash? Do we have enough current assets to cover the current debt that we've got that we're obligated to pay? So accounts payable and any short-term 12-month or less debt that we owe, notes payable, right? So if we look at this company and we take the current ratio, so current assets of 2168 divided by our current liabilities of 1995, we get a current ratio of 1.09 times. So we've got 9% more current assets than we do current liabilities. So we're greater than 1, which that's a good thing, right? We've got more current assets. We've got the ability to convert current assets into cash if we needed to in order to pay off our short-term debt, right? So that's great. It's a data point, 1.09 times. Question to you, is that good or is that bad? 1.09, good or bad?
I mean, I'd say it's pretty good because it's over 1.
Okay, it's good because it's over 1. Anybody else got a different opinion? Just say it's bad, Mark.
It's kind of subjective. Well, subjective, and it's not like significantly over 1. So.
Okay, so the point here is that both of you could be right, right? Both of you could be completely right. We don't know what industry that this business operates within. We don't know if this business is a cash heavy, business, right? All we know is that right now they've got 9% more current assets than they do current liabilities. So at this snapshot in time, we can kind of say that, okay, at least they've got enough current assets to cover whatever their 12-month liabilities look like. Now, whether that's good or bad, we can't really say right now. Eric says if it's below 1, we can't pay our bills, not liquid enough to pay short term. Over a 12-month period of time, that's exactly right. Okay, if the current ratio is less than 1, it means that we could have some solvency issues arise. But to say whether 1.09 is good or bad, we can't make that determination simply by looking at that number. It requires a comparative analysis. What I will say is directionally, anything over 1 is a good thing to have, right? Because that means that we're able to pay our 12-month bills. So moving to the quick ratio. also known as the acid test, ACID, acid test, right? Not like Jimi Hendrix acid, but acid test, right? Current assets, but we strip out inventory, all right? The least liquid of the three types of current assets that we're going to talk about in this class. So we strip out inventory and we divide that by current liability. Okay, so current assets minus inventory divided by current liabilities. And we see when we do that, our acid test drops to 0.84. Again, good or bad? We'll get there. The third, cash ratio. Strictly looking at cash only. We take cash divided by current liabilities, right? And now all of a sudden we drop to 0.05 from the cash ratio. So on the midterm, if I were to tell you that the current ratio is 1.09, the acid test is 0.84, and the cash ratio is 0.05, and I asked you to tell me where is the biggest problem occurring within this company? Where is the most sensitive current asset? What is the most sensitive current asset? Where does the majority of the current assets lie? If we think about what goes into the current ratio of cash, AR, inventory, other, for whatever, for that matter, I'm not going to test you on other. And then between those three things, if all I said was current is 1.09, quick is 0.84, and cash is 0.05, what could you tell me directionally about those current assets? What's the largest influencer within these calculations?
Inventory.
Not inventory, because inventory, if we stripped out inventory, current ratio to acid test, that only went from 109 to 0.84, right? So it did have an impact, but when we looked from the quick to the cash and it went from 0.84 to 0.05, what's still in this number that's not in this number?
Accounts receivable.
Will, good job. Chad, good job. Accounts receivable. Okay. The difference here, right? We got a current accounts, right? Which is cash, accounts receivable, inventory. And in this case, we've got some other current assets, but it's minimal compared to what we're going to talk about. So we got current assets, and inventory. So therefore, if we're only looking at cash here, the only remaining variable in this entire thing is accounts receivable. So that tells us that we've got a huge impact from accounts receivable within our liquidity, right? Because inventory, yes, dropped the current to acid from 1.09 to 0.84, but not by that much, right? That's gonna happen. But the big drop was 0.84 to 0.05 when we said, let's strip out inventory and let's look at what's left, cash and AR and other. It dropped drastically, which means that we are overloaded on AR and other current assets, okay? So I could give you three different numbers and you could give me some idea of where they're overloaded in terms of their current assets, right? Does that make sense? Okay. All right. So when we think about the net working capital to total assets, right? So what amount of assets are required to run the day-to-day operations of the company, all right? Essentially, the extent of the assets that are tied up in keeping the company running on a daily basis, right? Only 3%, okay? However, even though that's relatively small, right, it's consistent with kind of the current ratio, right? we're generating 1.09 times current assets over current liabilities. So we're 9% higher on our current assets versus liabilities. And we're getting net working capital. So 3%, okay, of the assets that we've got that are required to run our day-to-day basis, 3% of those are tied up in producing the cash that's needed to run the operations, okay? I'm not gonna test you on interval measure, but just know that the interval measure in this case means that it takes essentially that the company can meet the average daily expenses with the current assets that they have for about 211 days of the year, okay? It's a metric, quite frankly, in all of my technical analysis that I've done for 15 and 20 years, I've never used interval measure, and I'm not gonna test you on it, okay? I will test you on these first four though. Okay, so that was short-term liquidity. Now we move more into long-term solvency. Okay, so we call these leverage ratios, right? So we've got the total debt ratio. So we take the total assets minus the total equity, and we divide that by the total assets, and we can see that 50.62%, okay, of the right-hand side of the balance sheet is related to the debt of the company. So we've got total assets minus total equity divided by total assets gives us our debt ratio. So we're about a 50-50 split. We've got debt to equity ratio. So total debt divided by total equity. So we've got 5606, which is our total debt, minus the equity component. So we're about 1.03 times more leveraged from a debt standpoint than we are using equity, which means it's about twice as much. So that's 103%, which leads us into the equity multiplier. And we'll talk about equity multiplier when we get to the DuPont identity here in just a second, right? So right now we're showing that the firm finances about 50% of their business, of its assets, with debt, right? So the numerator on the total debt ratio, okay, is also found by adding all of the current and long-term liabilities. Okay, so current liabilities plus long-term debt equals total debt, all right? That's what this is. So the total debt is 5606, current and long-term, okay? So this equity multiplier is a measure of leverage, all right? And it measures and represents the level of assets that are financed by debt versus equity, okay? So we've got the equity multiplier of 2.03, which means that we're looking at 2.03 times our assets that are financed by debt versus equity, okay? So we're much more leveraged on the debt side, obviously, because we've got total debt of 5606 and we've got total equity of 2768, okay? So when we look at the equity multiplier, the higher the equity multiplier, the more leveraged we are. Meaning the more leveraged we are, the more debt we've taken on within our business as it relates to financing through equity. So the higher the equity multiplier, the more debt we're taking on to generate more leverage for the firm as compared to using our equity to finance the growth of our business. Okay. Coverage ratios. We have a ratio called the times interest earned, all right? So when we talk about coverage, we're talking about what's our ability to pay the interest on the debt that we owe, right? So the TIE ratio, TIE times interest earned, is simply EBIT divided by interest. So in this example, we only paid $7 million out in interest paid, but we had EBIT of $1.138 billion. So our TIE ratio was 162.57. So pretty sure we've got the ability to take care of the interest that's owed from the creditors that have given us money. Then we have cash coverage. So just like we had the quick ratio, the acid test, and the cash ratio, we have a coverage ratio that factors in depreciation by taking EBIT, which includes depreciation. Okay, we add that back in to kind of eliminate that non-cash item to get back to EBITDA, which is kind of our free cash flow metric. And then we divide that by the interest. So in this case, they had 1.138 billion, they had 168 million in depreciation, and we take that sum and we divide it by the 7 million. And now our cash coverage ratio is 179.14. Okay, so again, just like we talked about short-term liquidity on coverage ratios, when the tie ratio and the cash coverage ratio converge on one another, it means that depreciation is having a relatively little impact on our ability to pay our bills. The non-cash item essentially becomes moot at that point, because the only difference between the two is the add back of depreciation. Okay, so if the tie ratio is equal to the cash coverage ratio, it means that there's zero depreciation for the company. Any questions on that one? Hit the chat room. Inventory turnover. Big, 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 important ratio for a lot of companies. Okay, inventory turnover is the cost of goods sold off of the income statement divided by the inventory. So we had $2 billion of cost of goods sold off the balance sheet, and we had a $501 million of inventory on the balance sheet. Okay, so 4 times. It means that we're turning over our inventory, we're replacing our inventory 4 times a year. Okay, so what does that mean? How many days sales do we have sitting on the shelf? Well, we take 365, which is the number of days in a year, and we divide that by the number of times we turn our inventory, and we get the number of days that are sitting on the shelf. 365 divided by 4, so we get 91 days. So this company has 91 days of product that's sitting there in the warehouse waiting to be sold, right? Within the data detective simulation, I will tell you right now that inventory turnover and days sales in inventory is going to give you a big hint in 2 of the companies that are unknown to you that you're trying to solve for. Okay, so let's think. What companies that might exist that are out there, what companies are going to have a really, really, really high inventory turnover? Meaning they probably go through product every day.
Restaurants.
Restaurants, very good. And it's obvious, right? Because food is perishable, right? So restaurants are going to have a high inventory turnover. What about like a Boeing Airlines? Not so much, right? Especially since they've got about, a few hundred 737 MAX jets that are fully ready to go that are still sitting on the tarmac, in Arizona and on the West Coast, right? So think about inventory turnover when you get into your simulation. Receivables ratio. How long does it take us to collect our money? Okay, so we take our sales and we divide it by our AR and we get receivables turnover. So in the case of this company, we have $5 billion in sales on $1.156 billion of AR. So we're collecting all of the money that we need to collect 4.33 times a year. And we convert that to days, and we did, again, take 365 divided by receivables turnover, and we get, on average, it's taking us 84 days to collect our money. Is that good or bad?
I would say bad. I mean, typically it's like net 30 or net 60, right? So Would it be bad to
All
get
right.
your money later?
It could be bad, right? It could be good. But like Morgan said, it depends upon the payment terms that this company's got, okay, with their customers, right? If they're on net 30, meaning the customers need to pay within 30 days of receiving their invoice, all right, it's pretty crappy because they're taking 84 days to collect their money versus the credit terms of 30 days. On the other hand, if they've got net 90 terms, then they're doing pretty good because they're collecting it 6 days ahead of when they're actually supposed to receive their money. So again, it depends. So you can't just look at these numbers and say, that's good, that's bad, because it is all relative. It all depends upon the industry that you're operating within and what types of terms you've got with your customers and your suppliers, okay? So total asset turnover, all right? How many times a year are our assets delivering our revenue, okay? So it is not uncommon. So in this case, we've got sales of 5 billion and we've got total assets of 5.6 billion. So our total asset turnover, we're not delivering on our revenues one full turn each year from our assets, all right? So what does that mean? So think about a power company, right? Where they're spending hundreds of millions of dollars of money to put in a gas-fired power plant to produce power for this region. They're not turning over their assets more than once a year, I can guarantee you that. They may not even be turning over their assets more than 0.25 times a year. But those assets are expensive and they're designed to last a long period of time. Okay, so it's not unusual for capital intensive businesses, manufacturing businesses, utility companies, chemical companies, oil and gas exploration companies. It's not unusual for them to have total asset turnover of less than 1, okay, because they require a significant number of fixed assets just to produce a single product, right? Net working capital turnover, sales divided by net working capital. How many times a year does our net capital, what we need to run the business on a day-to-day basis, turn over? Obviously, the higher number, the better. Our fixed asset turnover, what are our fixed assets delivering to us? So again, total assets also includes cash, AR, inventory, okay? But our fixed asset turnover is just the net fixed asset component of the balance sheet, okay? So 0.89 for total and 1.45 times for the fixed asset turnover. Right? And we're going to talk more about the total asset turnover as it relates to this DuPont identity theory here in just a second. Profitability, okay? Those of you in finance and accounting are certain to understand these. Profit margin, net income divided by sales. How much money do we keep at the bottom line of the income statement as it relates to how much money we brought in at the top line? So 17 cents on every dollar, 18 cents of every dollar that came in the door flowed to the bottom line. That allows us as financial managers to determine whether we pay out in dividends versus addition to retained earnings. Return on assets, net income divided by total assets. All right. So what kind of return did we get for the assets that we have put in place? Are we making good use of the cash that we've got by efficiently adding to or taking away some of the assets that are either efficient or inefficient to improve our profitability? Return on equity, net income divided by total equity, right? Essentially, in this case, it's 32.26%. That's the return that we're getting for the equity financed portion of our business. Market values, all right? So if we have a case here where this company is trading at 87.65 per share, we know we've got 190 million shares that are outstanding in the market, okay? So our price to earnings ratio that we can calculate based upon the income statement from earlier tonight. We take the price of 87.65 divided by our earnings per share of 4.68, and we get a PE ratio, aka multiple, of 18.73. So we're trading it, the share price is $87.65, and the firm is earning $4.68 per share. So the PE is 18.73 times. So let's think about that for a second. If you were willing to buy one share of this company at 87.65, can somebody in layman's terms tell me what you're actually buying at that point? You're buying one share at 87.65. We know that. But based upon this PE ratio of 18.73, what are you actually buying? What are you believing in as it relates to this company? The company just made $4.68 per share, period. Period. Earnings per share, net income divided by shares outstanding. They made $4.68. But you're willing to pay $87.65 for one share of that company. What are you buying?
Professor?
Yes.
I don't know if this is right, but would it just be that you're essentially thinking that when you invest, you're expecting higher earnings in the future?
Okay, that's very good. Thank you, Annalise. Right, you're expecting that EPS is going to go up over a period of time. Your share price is going to go up over a period of time. But on the day that you bought one share of this company at 87.65, you have essentially said, this is what you've essentially said. You have said that, you know what, I believe in the long-term viability of this business. And right now, I'm willing today to pay $87.65 for one share, which means I'm willing to pay for 18.7 years worth of earnings at $4.68. Okay, I'm willing to pay today for 18.7 future years of at least $4.68 per share. So what Annalise said is correct. You're anticipating and believing that over the period of time that you own this company, that this EPS is going to go up, all right? That this multiple, 18.7, is going to stay at parity, and 18.7 times a higher EPS is going to lead to a higher share price, therefore delivering more wealth to you. Does everyone see that logic? Market price. Shares outstanding. We have net income of $893 million. $893 million of net income divided by 190.9 million shares gives us $4.68 per share of earnings. We have a market price, a price of 87.65. So 87.65, the price divided by earnings, so PE ratio is 18.7. So this company is trading at 18.73 times their earnings per share. So 18.73 times 4.68 gives you 87.65. So Annalise's point was simply, you're buying this company believing that over the period of time that you own them, that this multiple, this relationship between stock price and earnings per share is going to remain relatively constant. Therefore, if you generate more money or you cut more cost, you generate more earnings per share. As your earnings per share goes up at a constant multiple, your share price must also go up to maintain that constant multiple. Does that make sense?
How constant are those multiples?
Oh, it's for shit. They're not very constant at all, but they're mostly related to the sector or the industry. Okay, so they will constantly fluctuate. And this is where we get into the whole conversation around share buybacks, right? So let's talk about that for a second. And I want you to think about the math here, okay? So we got 4 different variables here. Share price, shares outstanding. We've got net income, number of earnings per share, and we've got a multiple, right? So in this example, let's say that this company is doing nothing to change how they operate, okay? They're not changing anything fundamental about their business, correct? Right? And the financial policy at Apple case study gets into this. And the company decides, you know what we're going to do? We've got a lot of cash that's sitting out there. Let's use some of our cash to buy back shares. So follow the logic. The company decides to buy back shares. So the shares outstanding goes down, right? If the shares outstanding goes down and we make the same amount of net income of $893 million, what's that?
Earnings per share goes up.
EPS goes up, right? So if EPS goes up and we keep the constant multiple, what happens to our share price? It's got to go up, right? So we just proved that share buybacks can, not always, can be for no other reason than to pump the stock price. Okay? You remove the number of shares from the marketplace on the same number of earnings. You create a new earnings per share that's higher than what it was before by not fundamentally changing anything about your business. And then all of a sudden, your share price goes up and everybody's happy. Now, why is that a potential conflict of interest? Getting back to the second lecture that we had. Why are share buybacks a potential conflict of interest?
Can't it, since it artificially, I'll say artificially inflates the stock price, it can mislead investors to think that the company's stock is doing better than it actually is? Because eventually it will level off.
Yep. I couldn't have said it any better myself. That is a great example of a potential conflict of interest. A second one would be, how are senior managers generally compensated at the end of every performance cycle? There's one number that is supposedly the one number that represents whether or not you've done a good job as a financial manager for a company. Stock price, right? The whole goal of financial manager, remember this from our second lecture, we want to increase shareholder wealth. And what's the one number that is traditionally representative of shareholder wealth? Stock price. Okay. And so if the goal of the financial manager is to increase shareholder wealth and their performance contract is based upon increasing shareholder wealth and the stock price goes up, which is indicative of shareholder wealth, the company may be incentivized to use their cash to simply buy shares to inflate the stock price, but that may not be the wisest use of their cash. Okay. So the Apple case, the financial policy at Apple back in 2013, when David Einhorn was coming in as an activist investor, trying to force Apple to make a decision on what they were going to do with their cash, relates very specifically to this. And quite frankly, you'll see within the case that Apple went on a massive, and still are, massive share buyback spree as a way to use their cash. Okay, so be wary of share buybacks. I'm not saying that they're all bad. There can certainly be, cases and times when it's a good thing to do. I'm just saying share buybacks, reverse splits are, generally speaking, optics more than anything fundamentally changing about the business dynamics that they're operating under. Okay. Enterprise value. All right, this is how we typically, if you're doing discounted cash flow analysis and you're trying to figure out what the 10-year pro forma for a business is, and then what the terminal value, the perpetuity value of a business is, we're looking at enterprise value, and we're talking about the market value of the stock. So number of shares outstanding times the current price of the stock. So that's the market capitalization of the stock within the market equals market value. So shares times stock price, adding in the book value of the liabilities and subtracting out the cash. That would give us the enterprise value for the business. So how much would you be willing to pay outright for this particular firm? Based upon the enterprise value, you'd be willing to pay $19,462 for the firm, okay? Based upon the market value and the book value of the liabilities and the cash. The quick and dirty, we look at the EBITDA ratio or the multiple, okay, where we take the enterprise value and we divide it by EBITDA for the given year, and we get 15.52. So it basically says that if you're doing a back of the envelope calculation for how much you might be willing to pay for a company, if you took the EBITDA in a given year and you multiplied it by 15.52, that would give you a ballpark estimate for how much you might be willing to pay for that business if you were going in to acquire the company. Okay, so we just call these either EV for enterprise value, we call it the multiple for the EBITDA ratio. Right. So DuPont identity, right? As an engineer myself, I find this extremely fascinating, right? And I will tell you right now, the guy who came up with this was either high, drunk, or high and drunk when he came up with this, all right? So let's start with return on equity. How do we go about figuring out return on equity? Well, go back 5 or 6 slides and we look at return on equity, the value that we derive from the equity financing portion of our business, and it is simply equal to net income divided by total equity, okay? How much money do we have left over at the bottom line divided by the total equity that we've got in our business? So this guy at DuPont says, well, that's all fine and dandy, but it doesn't really tell me anything about how my business is actually running. And I want to know how my business is running and where my weak spots are. So the first thing he does is he said, all right, I'm going to take the net income over total equity. And I need something that relates to my assets. I know that I've got to have some component of my return on equity that's tied to my assets, because I know that I use my equity to invest in assets. So I need to have a component within return on equity that relates specifically to assets. So he says, you know what I'm going to do? I'm going to take net income divided by total equity, okay? And I'm going to multiply it by total assets over total assets. Okay, which obviously you can do because total assets over total assets is equal to 1. So therefore, ROE is still nothing other than net income divided by total equity. So this is 1, so we're still at parity with return on equity. And then he says, well, I'm going to rearrange a few things. And quite frankly, not only that, but when I rearrange a few things, it looks a lot like something else. So I'm going to take total assets and shove it underneath net income, and now I'm going to have net income over total assets. All right, so net income now over total assets, And now I've got total assets over total equity. Okay? So net income over total assets, well, that looks awfully familiar. That looks like return on assets. And total assets over total equity, well, that looks awfully familiar. That's the equity multiplier. The leverage ratio. So then he puffs a little more on his little Mary Jane, or his marijuana, as they say in We're the Millers, all right? And he says, I'm going to take it one step further. And now I'm going to take all of that and I'm going to multiply by sales over sales, because I need to know from an operational standpoint, how well am I controlling my costs, right? Return on equity is great, but the whole point of equity is to procure assets that produce revenue, and then to bring that revenue into the business and then manage my expenses such that I keep more at the bottom line than I did before. So I want to know what's happening operationally. So he says, I'm going to multiply all this crap by sales over sales. So he takes ROA and the equity multiplier, and he multiplies it by sales over sales. And he says, well, now I can rearrange this crap all again. So I can get three different components. Now I can get net income over sales. All right, net income over sales. Well, net income over sales is profit margin. So now I've got an operational component to my return on equity calculation. Sales over total assets. How many times a year am I turning over my assets to produce revenue? Really important number. Total asset turnover. And then how am I going about doing this from a leverage and financing standpoint? So I've got total assets over total equity as my equity multiplier. So now I've taken this super simple net income over total equity, which is return on equity. You will get the same answer if you do it both of these ways. But now we have visibility into the operational aspect of our business, the turnover asset to our business, how well are we managing the assets, and then how are we going about financing the business. So now we get visibility into the three most important parts of how we use our money to drive revenue. All right, so return on equity, net income over total equity. Again, the high and most likely drunk guy at DuPont decided to multiply by total assets over total assets and multiply by sales over sales. And when you do that and you rearrange it, you get this beautiful formula that shows you visibility into the three most important aspects of running a company. How well are you controlling your costs? Okay. How well are you managing your assets? And how well are you doing financing your assets through debt or equity? Okay, super, super, super awesome formula that I absolutely am impressed by every single time I go through this discussion. Okay, so we've got profit margin. Measure of the firm's operating efficiency. How is it controlling costs? Total asset turnover. Measure of the firm's asset use efficiency. How is it managing our assets? And then finally, equity multiplier. How is the firm managing its financing from a debt and equity standpoint? And when we look at this in a graphical form, we can see how beautiful it is. All right, we have income statement items in blue. We have balance sheet items in this puke green over here. So we have taxes, interest, SG&A, cost of goods, R&D. We've got total costs, right? We subtract that out from sales and we get net income. Okay, we divide net income, sales divided by net income, sales divided by net income to get profit margin. Okay, net income over sales to get profit margin. On the balance sheet side, so there's the PM, all right? There's the first component of the DuPont identity, net income divided by sales. The balance sheet side, AR, inventory, cash, current assets plus fixed assets equals our total assets. Okay. We take our sales divided by total assets and we get total asset turnover, right? The second component to the DuPont identity. We take PM times the TAT and we get, okay, return on our assets multiplied by the equity multiplier, and we get return on equity. Again, in a million years, I never could come up with something like this, but it's beautiful and it works. All right, so you've got two ways to calculate return on equity. Net income over total equity, that's great. It gives you a number. But what I'm trying to convey to you as students in a graduate class is that I don't care if you can calculate net income divided by total equity. I can take anybody off the street, spin them around 5 times, show them the formula, and they'll be able to calculate return on equity. But they can't tell me what it means. Okay? When you're tested on this, I expect you to tell me what it means. So the DuPont identity allows you to tell me exactly where the return on equity is coming from. What is driving it? Where are the strengths? Where are the weaknesses? We're controlling our costs, but we kind of suck on our asset turnover and we're financing it too much with debt or with too much with equity. All right? Tell me the components of return on equity. What is driving it? Not just a number. Okay. So why do we go about doing all this? Well, 2 reasons. One, for the most part, you get compensated on it. Okay, your performance evaluations, all right, are going to be tied to some of these metrics. If the company does well, hopefully, you get a larger bonus. Okay, so if the goals are aligned and your performance metrics are aligned with the goals of the company, then if you're paying attention to these ratios and you're paying attention to controlling costs within the business, it ought to be a direct flow through to your own personal net income within your personal life. Okay, allows us to plan for the future. When we get 2 weeks from now, we're going to talk about estimating future cash flows on a 10-year pro forma with the Heritage Doll case, doing discounted cash flow analysis. Okay, it allows us to predict with relative certainty what the cash flows are going to look like at a future point in time. External uses, possibly more important than internal. By looking at these ratios, by trending the ratios, it allows us to keep control over what we have. And if we're going out and we're trying to finance new projects with debt, and we know we're going to have to take on new debt, then we know we're going to have to eventually pay interest to the creditors. Then if we've got a decent history, a decent trend of our solvency ratios being pretty solid, then we're going to get access to better credit terms, which saves us tremendous amounts of money over the life of that loan. So we use these financial ratios, solvency, liquidity, performance, okay, in order to obtain better credit in the marketplace. And not only that, but it attracts shareholders, okay? If we have a well-run business, okay, people are going to want to invest in our business. They're more likely to come and invest in our company because we generate quality returns as opposed to returns that are generated through overly leveraged financing. Okay. So benchmarking, right? When we get into your, so you've got 2 things that you're going to do this week between, tomorrow and, next Monday. And one of those is the simulation, the data detective simulation, where you're going to be given 8 random companies with common sized financial statements and all the financial ratios that we've talked about. You're going to have to do some research. Okay. It's not just going to be what's presented to you. You're probably going to need to use, the magical internet to go out and try to understand the sector, the industry averages for the companies that are presented to you that are unknown to you. But they will have a company profile around. So some of them will be fairly obvious to kind of figure out what the actual company is so that you can go and do research on your own. Okay. So you'll be using ratio analysis and common sized financial statements to try to figure out which company goes where. The second assignment that you've got is to go through the mini case on a company, an airline company called S&S Air. And you'll be given a number of items from the balance sheet, a number of items from the financial statement. You'll need to create a table with the financial ratios for S&S Air. You'll be given a table for benchmarks, okay, low, median, high, for the various financial ratios that you're going to be using to compare S&S Air against the sector, okay. You're also going to be given a number of competitors to S&S Air, like Embraer, Cirrus, Boeing, okay? And you're going to need to give me your perspective on what you feel would be the most comparable company for S&S Air to be compared against, right? And why, right? So if you feel that Boeing is a good comp for S&S Air, don't just say Boeing's a good comp. I expect you to have gone to the Boeing website to see what line of business Boeing is in, and then read what their line of business is and compare that to what the line of business that the mini case is in, okay? And give me, this is why I think Boeing is not, this is why I think Boeing is, right? And do that for each of the other comps that are within the mini case, okay? So peer group analysis is what we're getting at here, right? So the mini case, I think there's 3 questions. One is super simple. You just build a table of ratios based upon the income statement and balance sheet that you're given. The second question is the comp analysis, where you're taking S&S Air and you're comparing it more macro level to 3 or 4 other industries, other companies within the same airline industry to determine which company would be most comparable to S&S Air. And then the third question is you're taking those ratios you did in question 1 and you're relating those to the sector averages for the airline industry, okay? And then giving some commentary in a paragraph form around how S&S Air compares to these sector averages. Now, you don't have to do every single financial ratio. It would take you 6 pages to do all of that probably. So pick a couple that stick out with you, okay? Like maybe there's the acid test versus the cash ratio that is out of whack a little bit between S&S Air and the industry averages, okay? So pick some that are outliers and then try to explain to me why you feel S&S Air might be in that position and what they might do to overcome that situation that they're in or capitalize on it if it's a positive. Okay. So when we talk about, this is the last slide for tonight, by the way. When we talk about some potential problems here, okay, one of the things about data mining is sometimes we go into a problem looking for a pattern. Sometimes we go into a problem looking for a specific outcome. Okay, it's one of the 12 cognitive biases that we talked about the first lecture of the semester. And so we stop seeing the data for what it really is, which is just data, right? We don't necessarily know which ratios are going to be the most relevant until we look at the ratios and we look at them not only in the context of the particular company, but also in the context of the industry that that company participates in. Okay, so getting back to the conversation we were having around the quick ratio and the current ratio, the acid test and the cash ratio, and whether or not they were good or bad. You don't know. Okay, so you're going to be putting these ratios together for the mini case. Try not to let your mind start creating your own solution in that, oh, well, the quick ratio is 1.02. Well, that's got to be bad because it's just barely greater than 1. See what I mean? Just mine the data, analyze the data, and then compare the data to the industry. Okay? don't go into it as you're going through the ratios thinking that this is good or this is bad. Mine the data, analyze the data, compare the data. Okay, then come to your conclusions based upon what you found, right? The other thing that we find is a lot of times we try to benchmark companies, okay, which is great. That's fine. It's another data point. Okay, well, we were talking about the whole price to earnings ratio and whether 18.73 was a reasonable number. I think the S&P 500, the average PE ratio of the S&P 500 right now is somewhere around a 15. Okay, so the 18.7 is trading higher than the S&P 500. What does that mean? Who gives a shit? It doesn't mean anything. It's just a data point. Okay, if you look at Amazon or Tesla or a high growth biotech company, you could see PE ratios of 400, 450, 500, simply because they're exceptionally high growth industries. Okay, so it's all relative depending upon how you're comparing the information. Okay. You also run into issues if you're dealing with liquidity and solvency, right? Especially around inventory, okay, where different accounting principles either operate on a FIFO or LIFO basis. So whether you account for inventory on a first in, first out, or a last in, first out basis. So just know that even though you calculate the ratios, there are a lot of extenuating circumstances that factor into what those numbers actually mean. Okay, so again, they're just data points. And when we get into some more of the technical analysis of securities post the midterm, we'll look at additional data points like Bollinger Bands and the MACD and relative strength index, put call ratio, the trend statistic. We'll get into some of those other data points that, in addition to what you're doing right now, which is the fundamental analysis of things that have already happened. Ratio analysis is fundamental analysis. We'll look at fundamental analysis with technical analysis and how that relates to the different forms of the markets and, you know, strong form, weak form, semi-strong form. And you'll be able to see that all these data points are information to you in order to help you make the best possible decision about what investments that you're going to put your money into or how you're going to spend your cash for the firm. Okay, so that is the last slide for tonight. So 2 assignments, again, like we talked about for next week. If you've got questions, hit the chat room while I'm finishing up my little chat here. If you've got questions, hit the chat room and I'll answer them before we cut off tonight. But again, 2 assignments for this week. The first will be posted. It's the S&S Air financial ratios, okay, which you will submit a Word document by next Monday with answers to the 3 questions on that, okay? And again, I'm not grading this for format, you know, or you know, grammatically correct. What I care about is whether or not you can clearly articulate your position, right? I am looking for right or wrong on like the actual calculation of the ratios, okay? I'm looking for right or wrong because that's just math. They give you all the data from the income statement and the balance sheet, so the ratios ought to be right, okay? But when it comes to question 2 and question 3, where you're asked to look at S&S Air in relation to some peers and S&S as it relates to financial ratio benchmarks, I'm looking for your opinions, okay? Your feelings, your position on why you believe one thing over the other, okay? Defend your position. Again, there's no right or wrong answer, but what I'm looking for is your ability to defend your position or not, okay? Question 1, you better get them all right because it's just math, okay? Just follow the formulas and you'll come up with the financial ratios. But don't just plug them into Excel and then just convert them into a Word document. Think about what they mean. Think about what S&S Air's asset turnover ratio means, okay? Think about what their ratio means in relation to the sector average. And what about S&Air's business model might lead to that total asset turnover looking like what it is. If they're a custom plane manufacturer, they probably have a below average asset turnover rate. Okay, so think about those kinds of things and then tell me what your position is. Okay, so that's assignment number one. Also, just not due until next Monday. Second assignment, which will be turned on tomorrow. So the Harvard data simulation, financial ratio simulation data detective. So for all day tomorrow, I'm going to open the simulation in tutorial mode only. Okay, so you won't have access to any of the companies themselves. You'll have access to learn how the simulation works and what's going to be expected of you. Okay, so that will open tomorrow. Then on Wednesday, all right, Wednesday morning, the full simulation will open. So if you log into this simulation on Wednesday morning, right, you will now have access to all 8 companies that you then need to isolate within the table of data that you're provided. And again, you'll have common sized financial statements, income statement and balance sheet, and you'll have financial ratios for each of the 8 companies. And then your job will be to, from a pull down menu, select, company A is Marriott, company B is Salesforce. Okay, so it's not just using the simulation, you're going to need to use some other tools. Okay, you're going to probably need to go to the web to research the sectors that this company operates within, to learn more about what some common sized financial statements look like, or common ratio analysis looks like. And then once you've made that selection, all right, it'll move you to another screen where then you're able to take the selections that you've made, and then you're going to give yourself a little confidence, right? I'm 95% confident this is right, or I'm 10% not confident that this is right, okay? And then why? Well, I'm 95% confident that this is right because, this particular financial ratio is exactly what it should be for the particular sector that this company operates in, right? So you're going to be giving me an explanation as to why you're so confident, or alternatively, conversely, why you're not as confident as you might otherwise be. But the point is that this is worth 10% of your grade. Okay, so I'm giving you a whole week to do it. But once you click submit, it submits it. Okay, if you accidentally submit it, I have the ability to reset it. Okay, so you're not totally screwed, right? But take the time to go through it and get it right. Make your notes, write things down, and very strategically go about picking out the ratios that your gut feeling tells you relate specifically to the sectors that you're dealing with. And there's no one company, there's no 2 companies that operate in the same sector. So they all operate in different market sectors, okay? So there's no trickiness here.
Hey, Professor, I have a quick question.
Sure.
You said like when you fill out one screen, it moves on to the next. If we don't do this all in one sitting, is there a save button that we can, come back to at a later time?
It automatically saves it.
Okay, perfect.
Okay, so the first screen that you're going to be presented with when you start the sim, right, deals with, it'll give you a very detailed explanation of the particular company, right? The next screen will be literally across the top, 8 different headers. Company A, B, C, D, E, F, G, H, I think that's 8. And then you'll have a little drop down underneath each one of those letters with all the possible companies that could be. And then below all of that, you'll have all of your data, okay? So you're gonna be analyzing the data for all 8 of those companies, all from that one screen, okay? It's not until you click next that you move to the next screen where it takes your responses and then asks you to provide the confidence level around your response with an explanation for the reason why you chose that. Okay, so it saves as you go along. So if you start it and you come back to it, it'll keep you where you're at. So you don't have to do it all in one sitting, I guess was your question.
Okay, thank you.
Yeah, you're welcome. So any other questions about tonight? And what is the deliverables for next Monday? And depending upon how adventurous you guys are, I'll go ahead and turn on the tutorial for the simulation tonight so you can at least go in and take a look at it.
Okay, Professor, one question about the S&S financial ratios.
Yeah, bro.
The third question, you said compare the S&S air to the industries, right? And you said choose the ratio that we think is best comparable. So we're not doing each ratio and comparing it. It's just, we're just choosing.
Yeah, let me just open it up and I'll show you what it looks like, okay? Did I share, am I still sharing my screen or did it drop off? I think it dropped off here. Hold on a second. Okay, so here it is. All right, so the mini case, ratio analysis at S&S Air. All right, you got a little description about the company. You're given income statement information. You're given balance sheet information. Okay, you're given the airplane industry sector ratio information. So lower quartile, upper quartile, median. All right, so for question one, you're going to use the financial statements above, the income statement, balance sheet, and then you're going to calculate every one of these ratios for S&S Air. Okay. Question two, all right, you're going to go in and you're going to say, all right, they want to pick a company that they're aspirational with. They want that, what is their closest peer? And it's asking you to evaluate Bombardier, Embraer, Cirrus, Aircraft, Cessna. Okay. So you're going to maybe go do a little research on the web, go to Bombardier's website, see what line of business they're in, see how it compares to the line of business that S&S Air is in. Go to Embraer, go to Cirrus, go to Cessna, all right? Do some research and then determine which of these companies you feel would be the most appropriate peer comp for S&S Air, okay? Boeing. Is Boeing a good company for S&S Air to aspire to become? Maybe, maybe not, right? When you read about S&S Air and their business model and you read about Boeing and their business model, are they really comparable to one another? That's for you to decide. Defend your position. And then finally, the third question, which was what your actual question was about, was related to comparing the performance of S&S Air to the industry. All right, so what I would suggest you guys do is kind of take this table, put it into Excel. In another column off to the right, put S&S Air's actual numbers. And then maybe put, I don't know, a deviation from mean column next to that. So you take S&S Air minus the mean so you can see whether they're above or below the mean. And then depending upon how far above and below the mean they are, maybe you pick 3 or 4 ratios that kind of stick out as being either like really low on the quartile spectrum or really high on the upper quartile spectrum. And then based upon what you've learned about the S&S Air business model, try to relate to kind of, okay, why is that ratio for S&S Air significantly higher than the industry average? Or why is it significantly lower than the industry average? So again, you don't have to provide commentary for every single one of these ratios, but definitely provide some commentary. And there will be some, I can guarantee you, there are definitely 4, 5, 6 ratios that are obvious outliers as it relates to the airline sector as a whole. Provide commentary around that. Okay? Does that answer your question?
Yes, sir. Thank you.
Yeah, bud. Okay. Any other, anything else for tonight? Any other questions, comments? Everybody understanding everything okay? All right. If you feel like you're behind, if you feel like you need more support on the mechanics between the income statement and the balance sheet, retained earnings, dividends, earnings per share, price to earnings ratio, cash flow from assets, you need to reach out to me, okay? Because I am more than happy to spend time with you one-on-one. Because when we start getting into next week, right, we're going to be moving full steam ahead into not just dealing with 1 year of growth forecast, but we're going to start dealing with 10 years of growth forecast and how we can use Excel and leverage Excel to our advantage to very easily project 10 years worth of growth in a matter of seconds within Excel. So if you're not super comfortable with Excel, reach out to me and I will work with you to get you up to speed with what you're going to need to know. So if you don't know how to fix a reference cell so that you can copy and paste a cell out for 10 to 12 different columns and have that one cell remain fixed while another cell varies, then reach out to me and we'll figure something out so that I can help you with that. Right? If you're an Excel master, then you'll be just fine. Okay, again, God's greatest gift to man was this program. So with that said, if there's no questions, that's it for tonight. And again, if you do have questions, reach out and I'm happy to spend time with you offline via Zoom.
Thanks, Professor. Bye-bye.
Yes.
Thanks, Professor.
Hey, have a great night, guys. Appreciate you attending. Thanks for your participation.